DSCR refinance loans. Hey, it's John Watkins, mortgage lender. Today, I want to break down how refinancing works with DSCR loans. Whether you're trying to lower your rate or pull out some equity, here's what you need to know. Basically, there are two types of refinancing. Just like with traditional loans, there are two main refinance options with DSCR. Number one is a rate and term refinance. You're not pulling cash out, you're just trying to lower your interest rate or get better terms. Number two is a cash out refinance. You're tapping into your property's equity and pulling out some cash using a DSCR loan. DSCR stands for debt service coverage ratio. It measures your property's income against its expenses, mainly principal, interest, taxes, and insurance. If the rent coming in is at least that amount, then you're usually good to go with a DSCR loan. There are some general guidelines I want to go over. Loan amounts up to about $2 million, investment properties only. This is not for primary residences. This works for both long-term rentals, traditional leases, and short-term rentals, Airbnb, VRBO. Let's talk about your loan to value. For a rate and term, you're usually going to be about 80% loan to value, ideally 75%. Cash out is usually capped at 70%. A few lenders will go to 75 or even 80, but rates and terms won't be as favorable. As far as property types go, these loans cover 1 to 4 unit residential, condos, townhomes, PUDs. Some lenders even go up to 5 to 10 units, which fills that weird gap between residential and commercial. If you've got one of those, let's talk. I've got lenders for that as well. Here's what's great about DSCR loans. You don't need tax returns, pay stubs, or employment verification. What we care about is a property's income. That's what qualifies you. We'll typically use a lease to verify income. If it's short-term rental or between tenants, we'll use the market rent analysis, which is done during the appraisal. Another great thing about DSCR loans is that there's no property limit. If you have 10 plus finance properties, you're likely capped out with Fannie or Freddie, but DSCR loans don't care. You can keep adding to your portfolio. Your loan terms are generally going to be 30-year fixed, 40-year fixed, or 5-to-1 ARM. ARM pricing isn't that much better. Fixed usually makes more sense. 40-year amortization is a great option if you're trying to improve cash flow. Interest only is also an option. If you need to boost cash flow or just want to lower payments short term, interest only is available and can help you meet the DSCR requirements. Let's talk about reserve requirements. As low as 3 months of reserves required. For cash out refis, you can use some of the cash you're pulling out to meet reserve requirements. That's a huge win. You're going to need a minimum of a 640 credit score, but as always, the better the credit, the better the rates and terms. Now, there's also a no ratio DSCR option where we don't look at the property's income at all. Rates and reserves are higher, but it's an option if you really need to get something done. Most DSCR loans come with a prepayment penalty, typically 1 to 5 years. The longer the prepayment penalty period, the better the rate. It's all about balance. We'll do the math and make sure it makes sense for your goals. As far as cost goes, you can expect 2 to 4 points depending on loan size and credit. Higher loan amounts generally cost less in points. These loans aren't the cheapest on the back end, but they are incredibly useful for investors. So whether you're a seasoned investor or just getting started, DSCR loans are a powerful tool to build and manage your portfolio. Rate and term or cash out, we can make it happen. This is my specialty, and I work with investors all across the country. Hey, if you want to talk through your scenario, book a time with me below. I'd love to help you run the numbers and make the right move.